Okay, so this is the 27th of September 2023, and this video is mainly for my own self awareness, basically, of trading. And I did not trade today. I was watching every trade that I would have made, and I know that sounds like shoulda, woulda, coulda, and all that, but I needed to take a break. Psychologically, I just needed to take a break. So I will be back at it tomorrow, but today was such a good trading day. And what I first looked at this morning was, and this is pre-market here, where the market really had not started making a move yet, but then you get right in this area um, where this purple line is the VWAP, and all the moving averages started pointing down. The market went. I don't know what happened there. Just a second. Let me pause it. Okay, so I'm not going to touch anything right now. So anyway, so everything was pointing down. The moving averages, it was going away from VWAP. My indicators down here are, this is the DMI, which is directional movement indicator or index, and sometimes it's just called the DM for directional movement. Here's the MACD. Everything was bearish. So all I was looking for, and like I said, this is the 15-minute chart. I like it when these are strong lines down or up if I'm going in the opposite direction. But then I go over here, I'm on the 5-minute chart right here. And so I was looking, and I was calling my own trades as I was going to do it. This one was, you had a lot of risk, but now the way I play these is, so you got this candle right here, you got a low of, I believe it's, let's see, oh, here. Yeah, the low was right at 23.25. This candle here that would have put you in that trade, it made the low of 22.75, but then I would put my stop above that high right there, which is 27. That's still 5 points. That's kind of a strong risk. I mean, I even on the 5-minute, everything was looking very bearish. It turned out to be a great trade, or you could just put your stop below this low, and right here, I mean your stop entry, and then put your buy stop to get out up above this candle that breaks through. That's two different ways you could trade it. Otherwise, you'd have to put it all the way up here. I'm not risking 10 points on a trade. So anyway, you had another scenario set up. You could have gotten, if you'd taken that one right here at 23, you could have gotten 10 points out of the deal. Here was another one where you put this setup right here below this low, this candle coming down. Again, you could put your sell stop to get in below this low, but if you want to trade the flag, the bear flag, you put it in below this low of this candle. And as I said before, once it breaks through, you put your stop above that high right there. So that risk would have been from 18.25 up to 20. You're a lot less risk. I mean, if you just wanted to stay away from that first risk, you would have been fine, and just let it hopefully come up and do it again, which it did. It's not going to do that every time, that's for sure. You have to watch your lines down here. Keep an eye over here on the 15-minute chart. But if you notice, everything is so strong with this. When these lines right here on the DM, when they really spread apart, going away from each other, that is a very bearish move when it's pointed down like that. And here you had another move right here. I would have, on safety's sake, I would have put my sell stop below this low right here. And that's just the way I trade it. Other people would want to maybe go a little tighter, bear flag. I like to spread it out. It went up into the 20 moving average on the red line is the 20. The yellow line or orange, whatever that is the 14. What happens, or wait a minute. Yeah, I believe the red's a 21. Anyway, same thing that I do before. The risk would have been below the low, and then, I mean, you get in below that low on a stop, and you buy it. You put your buy stop above that high right there. You could have made throw 8 down to, on this move down, it'd been 7 points or whatever. If you just hung in, put your stop right here, or once it made this low, you put your stop above that high right there at 06. So you guaranteed 2 points. Oh, wait a minute, that was below, that was 10, 0975, I'm sorry. So 0925 you would have gotten in. You put your stop above that high at 0675. So you got $150 per contract, and then just let it run. If you can do that, some people can't do that. But when this is so strong, when this is spread apart, like this is the DM on this one, this is the MACD, everything is looking bearish, and so I would just let it ride. So anyway, just wanted to throw that. I'm sharing my notes. These are basically my notes that I personally, I'm just gonna put it out there for everybody else to see. And the other day I got in and I really screwed the pooch because I didn't let things happen the way they should have. And look at that. Look at all that mess. It was going down, but I wasn't waiting for the right moves, and I started just going back and forth, and I just got stupid, is what it was. And I got to the point there, and I didn't care. And I had an evaluation account, and I blew it, and that was my fault. This morning I woke up and I said, okay, I'm going to only take an A+ trade, and I know people, are using that term quite often these days. These were A+ trades. It was going down, pull back, then you break the line of the bear flag, and you get in. So I hope this helped other people, which, like I said, it's for my personal use. I can go back and look at this, and I can see when, in my mind, when I need to review what kind of trading I need to be doing, this is what it is right here, folks. So hope you had a good trading day, and I will be in the markets again tomorrow. So we will see you later in the next video. Thanks for watching.